Somewhere between your brokerage statement and your grocery bill, money is disappearing, and it has nothing to do with your fund manager. That gap between your nominal number and your actual purchasing power has a name: the silent tax. Today we trace exactly how a distant waterway quietly charges that silent tax on you. No energy stocks required. The chain reaches every corner of a diversified portfolio. The Strait of Hormuz is a roughly 21-mile-wide navigable channel squeezed between Iran and Oman. Around 17 to 21 million barrels of oil pass through it every single day, depending on the year. That is roughly 20% of all the oil traded globally each day. There is no easy alternate route. Overland pipelines bypass only a small fraction of that volume. Pinch that gap even partially, and the oil market tightens almost instantly. U.S. strikes near Hormuz have escalated alongside Iranian proxy activity through 2024 and into 2025. Iran has previously threatened closure during periods of maximum diplomatic pressure. This is on the record. Markets do not need a full closure to react. Credible risk alone is enough to move prices. The silent tax starts charging the moment uncertainty enters the oil market. No disruption required. Oil is priced at the margin. The last barrel sold sets the price for every barrel in the market. Remove a few percent of supply and prices can jump 20 to 30%. The response is nonlinear. That outsized response is why traders watch Hormuz like a smoke detector, always on, never sleeping. During the 1973 Arab embargo, a supply cut of roughly 5% helped push prices up sharply within months. During the 1990 Gulf War, oil roughly doubled in about 3 months before reversing sharply. Oil is an input cost for a huge share of goods and services. Think fuel for every truck, tractor, and factory. Higher oil raises trucking, farming, manufacturing, and airline costs all at the same time. Those costs typically flow into consumer prices within about 3 to 6 months on average. This is where the silent tax starts showing up on your grocery receipt, line by line. Historically, a large oil price spike has added roughly half a percentage point or more to CPI. Real return equals your nominal gain minus inflation. That subtraction is the silent tax doing its quiet work. Earn 7% nominally, while inflation runs 5%, and your real gain is just 2%. 2% real on a $50,000 portfolio is $1,000 of actual new purchasing power. An extra inflation point from an oil shock cuts that real gain by roughly $500. Over a decade of compounding, that lost $500 can grow into a much larger whole. When inflation expectations rise, bond yields rise, and existing bond prices fall. A 1 percentage point yield increase on a 10-year bond cuts its price by roughly 8 to 9%. That price drop is the silent tax visiting your supposedly safe allocation. The 2022 U.S. Aggregate Bond Index drawdown was among the worst in decades, partly driven by energy inflation. Higher inflation pushes central banks to raise interest rates to cool the economy. Higher rates raise the discount rate, used to value future corporate earnings. When the discount rate rises, the present value of stocks falls, even if earnings stay perfectly flat. A meaningful P/E compression on a broad index can imply a double-digit price decline before earnings even move. And that is before any actual earnings damage from higher input costs hits company bottom lines. Geopolitical shocks do not just move prices, they spike volatility, the market's fear gauge. The VIX spiked sharply during the Gulf War in 1990 and again during the 2022 Ukraine shock. Higher volatility means wider bid-ask spreads, so selling assets costs more than you expect. That is the silent tax, charging a transaction fee you will never see itemized on your statement. High volatility periods also trigger margin calls, forcing liquidations that can amplify drawdowns further. Diversification math assumes asset correlations stay roughly stable over time. During geopolitical shocks, correlations between stocks and bonds can flip sharply toward one. When everything falls together, your diversification benefit temporarily shrinks toward zero. This happened in 2022. The classic 60/40 portfolio had one of its worst years in decades. The silent tax had help from correlation that year. Diversification did not fully protect you. Growth stocks with long-duration earnings feel the rate rise pain most acutely. Value stocks with near-term earnings and real assets tend to hold up comparatively better. This factor rotation is well documented. Value meaningfully outperformed growth in 2022, but the silent tax still charges value investors just a slightly smaller bill. Energy stocks often rise when oil rises, making them a natural partial offset to the silent tax. In 2022, the energy sector gained roughly 59%, while the S&P 500 fell around 18%. But energy stocks carry their own volatility. They can fall just as fast when oil reverses. Owning energy purely as a geopolitical hedge means accepting commodity price risk as a passenger. The silent tax on a wrong-timed energy bet can exceed the inflation it was meant to offset. Treasury inflation-protected securities adjust their principal with the CPI automatically. When CPI rises 1%, a TIPS bond's principal grows by 1% too. That mechanism can partially blunt the silent tax on the fixed income side of your portfolio. Real assets like commodities and infrastructure also tend to move with inflation more directly. No single instrument eliminates the silent tax. Each one just shifts where it bites you. Gold has historically risen during periods of geopolitical stress and dollar uncertainty. During the 1970s oil shocks, gold rose sharply, though the exact figure varies by measurement period. Gold also sat roughly flat for nearly 2 decades from the early 1980s to 2000. It is not a consistent performer. Gold's role is reducing portfolio variance during tail events, not reliably boosting average returns. The silent tax still operates in gold. You pay storage costs, wide spreads, and opportunity cost. Oil is priced globally in US dollars, so dollar strength shapes how a supply shock spreads internationally. A stronger dollar can partially offset oil price rises for US consumers, but it hurts exporters abroad. International equity holdings lose value when the dollar strengthens, another layer of the silent tax. A significant dollar rally can wipe a meaningful percentage off unhedged international returns. Let us run 3 historical episodes as rough stress tests for how you think about your portfolio. 1973. Arab embargo cut supply sharply, oil prices surged, and the S&P 500 fell roughly 40 to 50% over 2 years. 1990. Gulf War roughly doubled oil in 3 months. The S&P fell around 20%, then recovered within 6 months. 2022. Energy prices surged, CPI hit multi-decade highs, and the classic 60/40 portfolio had its worst year in a generation. Each episode charged a different rate. The silent tax bill varied in size but always arrived. But the transmission mechanism, oil to inflation to rates to valuations, repeated every single time. Oil futures markets give a real-time read on what traders collectively expect for near-term supply. When the futures curve goes into backwardation, near-term prices exceed future prices, a supply fear signal. The CBOE Crude Oil Volatility Index, OVX, measures implied volatility in crude oil options. Elevated OVX readings have historically coincided with periods when the silent tax accelerates. These are not predictions. They are signals that uncertainty is being priced, not resolved. The break-even inflation rate is the difference between nominal Treasury yields and TIPS yields of the same maturity. When break-even rates rise, the bond market is pricing more inflation into the future. A rising break-even is an early warning that the silent tax may be about to get more expensive. You can track the 10-year break-even daily on the Federal Reserve's FRED database. It is free. A Hormuz disruption would also spike shipping insurance costs, adding a second layer to the silent tax. During the 2023 to 2024 Red Sea disruption, some shipping rates rose sharply in a matter of weeks. Higher shipping costs add to goods inflation even before the oil price change reaches consumers. This compounding of supply chain costs is how the silent tax quietly finds a second gear. Oil importing emerging markets face a triple pressure: higher oil costs, a stronger dollar, and capital flight. Their currencies weaken, making imported oil even more expensive in local terms. Hold an emerging market fund, and the silent tax charges you in both equity and currency simultaneously. Historically, equities have tended to underperform developed markets during major oil shocks. Higher mortgage rates follow higher treasury yields, which follow higher inflation expectations. The chain reaches your front door. A 1 percentage point mortgage rate increase on a $400,000 loan adds roughly $240 more per month. That is nearly $3,000 a year in extra housing cost, the silent tax on your biggest asset. Existing homeowners with fixed rates are partially insulated. Buyers and refinancers are not so lucky. Nobody can predict whether the Strait of Hormuz will be disrupted or for how long. The useful frame is expected value, probability times impact, mapped across multiple scenarios. Even a modest probability of a large oil spike carries a meaningful expected impact on inflation. Investors who ignore low probability, high-impact events end up paying the silent tax as a surprise bill. Investors who obsess over them pay in unnecessary trading costs and forgone upside instead. You do not need to predict anything. You need a small set of signals to monitor regularly. Signal 1. The 10-year break-even inflation rate on FRED. Watch for unusual moves above recent norms. Signal 2. The OVX Oil Volatility Index. Elevated readings indicate stress in the oil market. Signal 3. The WTI crude oil futures curve shape. Backwardation signals near-term supply fear. Signal 4. The DXY Dollar Index. A rising dollar amplifies the silent tax on international holdings. None of these signals tells you what to do. They tell you how much the silent tax is charging right now. Systematic rebalancing forces you to buy assets that fell and trim assets that rose automatically. During a geopolitical spike, energy rises while bonds fall. Rebalancing sells some energy and adds bonds. Research suggests disciplined rebalancing has historically improved risk-adjusted returns by a modest but meaningful margin. That small improvement partially offsets the silent tax without requiring any geopolitical forecast. Duration measures how sensitive your bond holdings are to interest rate changes. A bond with a duration of 10 loses roughly 10% for every 1 percentage point rate rise. Shorter duration bonds lose less in a rate rise, but they also earn less. Classic trade-off. Knowing your portfolio's average duration tells you how hard the silent tax can bite via rates. A small commodity allocation has historically helped reduce portfolio volatility during inflationary episodes. Research suggests a modest allocation to a broad commodity index can provide meaningful inflation sensitivity. Commodity indices carry their own costs. Roll yield drag can subtract 1 to 2% annually. The silent tax on commodities is that drag. No hedge is free of its own version of the silent tax. The strongest case for monitoring the silent tax is what compounding does to even small return differences. A portfolio earning 5% real versus 3% real produces a dramatically larger gap over 20 years. On a $100,000 starting portfolio, that gap can amount to a six-figure difference over 2 decades. The silent tax, left unmonitored, quietly erodes that second stack year by year. Awareness does not guarantee you capture the full real return, but ignorance guarantees you do not. You cannot control whether Iran closes the Strait of Hormuz or whether the U.S. escalates further. You cannot control oil prices, CPI prints, or Federal Reserve decisions. What you can control is your portfolio's duration, diversification, cost structure, and rebalancing discipline. Focusing on controllable levers is how investors reduce the silent tax over long-time horizons. Investment costs are the only tax that is completely certain. Unlike inflation, they never reverse. A fund charging 1% annually versus a low-cost alternative compounds into a very large difference over decades. During inflationary periods, high-cost funds make the silent tax even louder. Fees stack on top of inflation drag. Minimizing costs is the clearest, most evidence-backed lever for reducing your total silent tax burden. Rather than predicting one outcome, think in three scenarios: mild, moderate, and severe disruption. Mild, a brief spike, oil up modestly, CPI barely moves, markets absorb it within months. Moderate, a sustained disruption, oil up meaningfully, inflation adds a point, equities correct. Severe, prolonged closure, oil surges, CPI adds multiple points, equity bear market territory. Assigning rough probabilities to each scenario lets you stress test your portfolio without needing a forecast. Geopolitical shocks have historically resolved faster in equity markets than economic recessions. After the Gulf War shock, the S&P 500 recovered its full loss within roughly 6 months of the trough. Investors who sold at the bottom of that shock locked in the loss permanently. The silent tax on panic selling is the foregone recovery, often larger than the initial drop itself. Time in the market, with a resilient allocation, has historically beaten timing the market around shocks. Preparation is not about predicting the next strike near Hormuz. It is about building portfolio resilience. Resilience means your real purchasing power survives a range of scenarios, not just the benign one. Review your duration exposure, your inflation-sensitive allocation, and your cost structure at least annually. That annual review is the simplest, cheapest way to keep the silent tax from compounding unnoticed. If this helped you see your portfolio differently, subscribe and hit the bell. We publish new quantitative finance explainers every week. Drop a comment with the signal you plan to start monitoring first. This video is for general educational purposes only and does not constitute financial, investment, or tax advice. Past performance does not guarantee future results. All figures and historical examples are approximate and for illustrative purposes only. Consult a qualified financial professional before making any investment decisions.